and welcome to episode 22 of Beat Up Exchange. My name's Adam, joined by James, and we have an awesome episode for you all today.
We are back. A little bit longer of a break than we typically like to go on, but
We're back with a banger.
We've been collecting stories for weeks now. So maybe a little rundown of where the market's at right now. There was a little bit of a pullback in equities this last week, specifically the AI names, just concerns again over is it going to materialize. So you saw rises in healthcare, energy, defense sectors. But something major that we kind of wanted to bring up is that the Fed is ending quantitative tightening. They've been doing this since June of 2022, back when inflation was really starting to ramp up post-COVID. So this marks an inflection point. Not necessarily that they're going towards quantitative easing now, but they are looking to end quantitative tightening by December 1st.
Right. And I think this is interesting, too, to just see how this plays out because, at least in my understanding, these are new tools that the Fed is using, quantitative easing and tightening, and going out in the market and buying longer-dated Treasuries, longer-dated MBS, and select assets. And I think the origin of this story is more a financial crisis happens, we need to find a way to raise asset prices, and that's how it came into existence. And that's to think at a moment right now where we're just letting, I don't know how many billions or trillions of dollars are still on the Fed's balance sheet of assets that they bought up that are just going to sit there. I don't know if that is a good thing, bad thing. I'd be curious to hear your thoughts.
Yeah, so, I mean, COVID time, or since COVID, it got up as high as $9 trillion on the Fed's balance sheet. That was June of 22. Now we're down to $6.5 trillion, so they've let.
Still seems like a lot.
I know, it doesn't seem too great, and I think one of the key points here, as you mentioned, the Fed trying to raise asset prices and thus lower interest rates. That's kind of the supplementary tool to lowering rates because, you know, you can only lower rates so far. So actually being able to purchase securities and then lower their interest rates is another means of doing that. So something I thought was interesting is that the Fed said that when they do eventually roll back into QE, they don't really want to include MBS, so they don't want to include mortgage-backed securities, only looking to do short-term treasuries, kind of saying that this is a defense measure and moving forward MBS might be a little bit too risky, but that kind of does draw the question where their focus is aligning. Of course, there's a giant debt spiral, debt crisis that we're in the midst of right now, so it looks like they're really trying to move towards lowering rates there and be able to help the U.S. government borrow at a cheaper rate. But you kind of do have to wonder about how that's going to affect mortgage-backed securities because then that raises the interest rates there. So it's kind of a weird balance we got.
Right, and I think that what made them buying up MBS attractive in the first place is because it's such a consumer-facing product that a lot of people need mortgages, so obviously that's something that's front and center for consumers of making sure that they have as low a mortgage rate as possible. But I think I'm in approval of this because I think that there is some moral hazard there in picking select products that you think are going to be the ones that you want to have low rates, so you're going to promote just a lot of issuance in that space and allow for asset bubbles and speculation, which I think isn't so great. And then I also see some moral hazard with, okay, we're in a place in the economy where we're neither, and it seems to be we're hoping to ease, but we're having a hard time doing it as far as the Fed's policy. And I'm not sure that there's ever a path to getting the $6.5 trillion off. I see them potentially easing sooner than they start selling off assets again. And I think that's a problem when you have a Fed who floods the system with money and there's no Congress approval that's writing on these QEs, and that's a lot of money. Like if there was ever a Congress bill for $6.5 trillion, it would make people's eyes water. And that a lot of inflation happened, a lot of banks went under because of it. So I think that there is some concern there for me as far as what is the total regime going to look like? Are we ever going to get to balance sheet zero, or is this thing just going to keep going up?
Yeah, I don't know. It's like as you said, banks too big to fail, and also taking these drastic measures is good when there's really tough times, when there's COVID, when there's of course great financial crisis in '08, but we are running really steep deficits every single year. So you do just have to wonder what's going to happen there.
Right. No, I wonder. These are good questions. I think one thing that was cool that the article mentioned was where gold was at, and that it tied it to these to them stopping quantitative tightening. And I think that is important distinction to make, that people think that we just live in a quantitative easing regime now, where we are just going to continue to buy assets, to hold long rates close, to be able to keep down short rates as well. And I think that shows that people are now starting to distrust the dollar, move into gold, and why gold might be in a structurally really good place if you have people who just don't trust the dollar, think that the Fed's going to print money, in recessions, and just allow that money to stay out there even when you're in quote-unquote normal economy.
Yep, agreed. And also, moving forward, we have seen bond yields at historically higher levels, even with rate cuts coming, so there already is concern throughout the markets, but that'll be something that we see unfold. Maybe can jump into our next current event story. New York City has a new mayor, Zohran Mamdani. Kind of unsurprising, I guess, to most, but he's going to be the mayor. It's official.
It's official. Congrats to Mamdani on the win. A very well-run campaign, as we talked about. Great marketing. Really was able to connect with young people and say a clear message about affordability crisis. A lot of business leaders are spooked about this, are spooked about what it means that there's going to be higher tax on corporations, less forgiving, friendly business environment. I'm not sure what the collaboration is going to look like with the private sector in terms of housing, in terms of infrastructure, whatever it might be. So those are things that we yet to see play out. But I think that the squeeze on a certain class of workers, on a certain class of young students and their frustrations was being able to be pinpointed by Mamdani. So congrats him on that.
Yeah. Congratulations. That was the best campaign I think I've ever seen in my life. The social media, the Instagram videos were all exceptional. And, of course, as you said, really connecting with the younger voter who's really stressed for affordability, can't afford their rent, even groceries, going out. We'll talk more about going out and eating a little sooner.
Right.
But, this is an inflection point, and as you said, big business doesn't love it, but you have seen some people like Jamie Dimon, Brian Moynihan coming out saying that they want to work with Mamdani and help him out to be able to make sure the city's in the right place. I also think that there's a lot of concerns in the real estate market. I think that might be the biggest place for concern with rent stabilization. But there's also some relief potentially. This article we were reading, he wants housing to get built, so he might be developer friendly, working to kind of lax some zoning regulations moving forward. So maybe even some tax abatements coming if there's money for that. But that's kind of where we're sitting at right now.
Right. And I think that one of the things that business leaders, and I'm more skewed to the real estate part of it because that's a lot of the news that is thrown at me, but that people in stabilized apartments are going to have their rent freezed, and policies like that I think that draws a lot of concern from people and draws a lot of concern from how are we going to make sure that there's an even distribution of fairness between what landlords are offering, what tenants are doing. So I think that is a place that people are concerned about, and just the socialist moniker as well, that we need more distribution of wealth, that we shouldn't have billionaires. Obviously, if you're one of these people who is a billionaire, that doesn't sit too well with you.
No, and you have to kind of think about the externalities. do more businesses end up moving to Miami, Texas, all throughout the country to kind of avoid these higher taxes. Not that it would be anything maybe too drastic, but you do have to wonder what business leaders are going to decide to do. And that's going to lose your revenue stream. But I think that New York is kind of this hub, and we talk about social capital and how this is the place where you make business, you make money, you have connections. So I don't think as many people are going to move as maybe some people have it out to be, but would love to hear your perspective on that.
And yeah, I don't have too much new to offer. I think what was interesting about some things that I read, and these are biased from people of New York City owner-operators, of them saying that leasing has been really strong, and we've seen from data that we've looked at. So as far as New York developers I was talking about, like rooted management, like Vornado, their leasing has been great. That a lot of businesses are saying that we want to stay here for the long term. That we're committed to New York. We see the growth there. We see the employment drivers there. So I think all that sort of stuff is important. That people have made those long-term commitments, and I think also it's generally just harder to move than people think. That people have kids in schools here that have made friends and such. That they have all their friends live here. That they grew up going to school here in some cases. That it's hard to just pack up your things and say, okay, Florida, that's where we want to be. But I think over time, like as people get more and more frustrated and they just get more and more headaches, that maybe that does start to become a concern.
Yeah, I agree with you. If this becomes some sort of a long run sort of outlook, yes, but I think that right now people are seeing this as a 4-year sort of experiment. I think that's what a lot of people are hearing, and if it goes according to plan, better to plan, I think people will be just fine. But
and how much actually happens, because we know that a lot of the folks in Albany and the state, they have a lot of power over some of this legislation as well. So we'll see what happens with taxes, because we know that Mamdani's probably leans farther left than the state as a whole.
Yep. All things to consider. We'll see how it unfolds, but definitely an interesting time in New York City.
Definitely.
But maybe staying on the topic of affordability,
Oh boy,
our favorite Chipotle, Cava, Sweetgreen, not doing so well. Kind of fast casual as a whole has been taking some hits. Cava's stock is down 60% this year. Chipotle is facing some struggles as well. And kind of the big thing here is that people are not willing to pay $15 for a slot bowl. That's what's going on.
I get it. I mean, I love the slot bowl. I'm an early adopter of the slot bowl, but it makes a lot of sense that we're living in a world where there's a squeezed consumer who doesn't have the resources necessarily to pay for $20 for lunch every day when you can go to a grocery store. I thought it was interesting that they mentioned grocery stores being the competition of Trader Joe's and such, that being able to get pre-made meals there at a cheaper price, that's something that they feel that they're actively competing against. So I think I don't know what to make of this, that a lot of these businesses need to figure out how to get to a lower price point, but I don't see the vision of how they're going to get there.
Yeah, it seems like a tough spot to be in, especially when there's a lot of economic uncertainty and you wonder how your food input prices are going to look moving forward. You don't even know what it's going to be tomorrow. But I think kind of the takeaway, and you touched on this, was Chipotle said that we're not losing to our competitors. We're losing, as you said, to the grocery stores, people meal prepping, bringing their own lunch, deciding to cook at home. That's who they're losing to. But when you think about how they're going to re-enter this market, we've seen, Taco Bell, McDonald's, kind of the more standard fast food chains adopting these budget-friendly sort of menu shifts. So, of course, you still have your big meals that are going to be, over $10, but you could get something from the value menu or the dollar menu, and finding ways to appeal to that lower or more cost-conscious customer is something that they need to do. And from what I understand, none of these places really have an affordable option. If you want any sort of meal, you're going to be spending at least $12.
And that's a problem I'm not sure how they fix. I think one company that I thought was interesting looking at that's on that list is Sweetgreen, that there's a big push there to try and automate a lot of the labor, that they have this elaborate concoction of digital kitchens and how they're going to, and them having a large portion of their revenue already coming from digital and mobile, that they're going to have just robots make the food. And I think that weighs on service too, that there are people there who are trying to interact with the workers at your company and form some sort of relationship there. And I think I have some sort of relationship with what I expected at Chipotle, because I can see the chicken on the grill when you go there, etc., in a way that you don't really have the same insight into at Sweetgreen. And I wonder how that plays out, of them trying to automate some of their workforce and where the human touch is coming in, because, I mean, everybody knows that they can go home and get something cheaper, but if you're willing to give people just some add on the experience, it helps them from just being reduced to this commodity level. Because when you're at the commodity level, then you're really playing against Burger King and McDonald's, etc.
Yeah, I don't know. Honestly, I kind of disagree with you. I think if they had robots, I would be totally fine if they can lower my bowl by a few bucks.
Mm-hmm.
And maybe some people think that way, but of course there is a human element, and that's why they're still in the fast casual and not just the fast food commodity-based side of the business. So you wonder if that's the appeal, but I really think these guys should offer some sort of a value menu. Maybe you have just single tacos, just something smaller that people can come together and actually go out to eat and not feel like they're going to blow their whole wallet on lunch, but just being able to be a part of the experience and maybe getting the larger item here and there. But for the most part, I do think that having some sort of a value add, I mean, maybe the margins wouldn't be great. Maybe it's not even feasible. I could be totally wrong, but I just feel like they really are missing that.
Yeah, maybe. And it's hard on the value front, because people both want quantity and price. Like, it's easy to have a smaller menu per se, where you sell stuff in smaller portions, but what people really want and would, I know, lower, because when they go out to lunch, they can't really come back with a half lunch. They need the whole thing somehow, and they need to keep money in their wallet. So it's a catch-22 for some of these folks. But I'm not really sure you solve it. But I think, interestingly enough, we've seen on some of the bottom rungs, and there's been mixed performance, but if you look at a stock like Wendy's that's getting crushed, that some of these other stocks that are also serving the low-end customers who we know are squeezed as well, that they're having some trouble too, just selling enough product and growing their same-store sales, which is the most important metric that investors want some insight into.
Yeah, good points too. I don't know. This is going to be a tough issue. Maybe I could see this fast food, fast casual as one of the first industries to truly adopt sort of this AI complete automation experience. But I don't know how far out we are from that, but I don't know. We'll see if they can help margins, if it can get more people buying their food. I'm sure it'll be used.
Yeah, and I think I've come around to that view too. That if it's a robot making the chicken and it's $5 less, then yeah, I'll buy it from the robot.
Sure. But someone else who's, our country's running big deficits, but so are colleges. Maybe we can jump into this next part.
Great transition.
Trying to find a way to connect it to chicken, but couldn't. So colleges, particularly as Wall Street Journal article cites, University of Chicago, been running some steep budget deficits for the last 14 years, really trying to revamp a lot of their buildings, spend a lot on research. And it's worked out really well. Since the 90s, University of Chicago has gone from 3,500 to 7,500 students enrolled, and took their acceptance rate from 70% to 5%. So definitely worked out, but today they're realizing that they need to cut some expenses, and their debt is really mounting over the amount that they're generating, and they're having to put some of these PhD programs on pause and some of these constructions. But I don't know. Take us away, Adam.
I think that thinking about colleges in terms of a business is like a hard framework to get into, because I think especially at the level of a school like UChicago is that what they're selling folks is prestige and name recognition. And I mean, I think that we've seen like through this debt story that obtaining that prestige takes some money, and getting the right professors in place that people care about, having research that you can speak to and tout and go on the road with, maybe that's something that helps. But trying to figure out what are the drivers of that, what are the buildings that you talked about, the physical real estate being something that is super important. But right now, we've seen that they're in cost-cutting mode. They're looking for things to cut. And one of the first things that gets cut is the PhD students, not unlike what's happening at Brown right now, which is also a story that's playing out of us being in a somewhat similar situation of us issuing more debt, becoming more levered as an institution, which is nutty. But I think it's interesting too of that they're the first people to go, because they're involved in the research profile, but also when you look around for things to cut, you cut athletics, your alumni go nuts. You cut undergrads, they're the ones who are making you the money. One of the things that we're being sold left and right are master's programs, which I'm sure are the things that make the most money, because there are no stipends, there's no grants, unlike the PhDs who all essentially go here for free. And when you cut PhDs in Slavic studies or sociology, maybe 10 people are going to take to the streets, as opposed to some of these other things that are really going to make alumni unhappy. So I think that this is probably the way I would go about it, but it's a tough thing when you have built up this prestige and essentially you have to pay for it at some point with today's students, because the students of years past got some of the gains.
Yeah, I mean, there's no free money, unfortunately, and this is sad. You know, the PhD program's getting cut, and they're also cutting some tenure-based professor positions, which is another really tough thing, because these are the people that really power these universities and move them up the rankings. So, of course, they don't want to have to do it, but as you said, cutting undergraduate funding, cutting sports is probably not going to fare well with the big donors and your big money makers. But I don't know. I think that this is becoming a trend with a lot of these institutions, and something else that was mentioned was, especially post-COVID, when rates were low, all these colleges were looking to invest in private equity and all these alternative asset classes that are very illiquid. So they have a lot of this money, but it's all tied up. We saw Yale having to sell a lot of these positions early and taking some big losses on that front. So these are great investments, but maybe not the place for colleges to go, at least not right now. And there's a lot of strain, especially coming from the federal government, with potentially a lot of grants and a lot of funding being cut, or threats of it being cut. Maybe that's not the place to go right now, but the damage might already be done.
Yeah, that's an interesting tie. I didn't connect the private equity story that we talked about a little bit ago with this one, so I think that I'm sure that is in play here and important. I think that is one thing that is, I think, is the business model here of why you would take on debt to reinvest, is that once you grow the prestige, you are not only enriching the possible earnings of these undergraduates who they're going out into labor force with a more prestigious degree, hopefully getting more earnings. Hopefully some of those earnings are coming back to you in the form of an endowment. I think that's something that makes the business model work. Because we know, even as a Brown student right now, that they need to dip into the endowment just to cover their operational expenses, which is nutty for how much the school costs. But that's the world that we live in. So I think that maybe they just need to wait a little bit longer for those cards to play out, that these people were students 15 years ago and 20 years ago, that maybe it's just going to take 10 more years for them to get the big ticket salaries that are going to trickle back into the school. And I think that what also is worth noting is that the school right now is just in a much more prestigious place, and they're going to be able to charge much higher rates on undergraduates. They're probably going to get a lot more alumni donations, so hopefully they're able to stabilize themselves, you would think. And that I would see, it's hard for me to say as someone who would hope that the school is doing well, that all these investments are for naught, and that taking on all this debt is going to unwind, and they're going to go back to being a 70% acceptance rate institution.
I don't know. You bring up some great points. I think that building that first round of prestige is incredibly important, and it's also going to help your credit rating moving forward. And it just builds that brand, and that is a huge part of what lures people in. And tuitions are, of course, at a insane level, so it's really almost crazy to think that these universities cannot pay their expenses when they're charging kids $100,000 a year. Well, their families in that as well. But yeah, this is just a weird, really tough issue, and maybe this is a very hard question to ask, but do you have any sort of ideas for how these universities can pull themselves out of it? Is it better spending habits, not going for the giant buildings? Is it some sort of alternative income stream? How are we going to do this?
I think that universities, by their very nature, and this is just me talking, and I think that this won't be agreed with widely, but I think that universities just in general tend to have a left-wing bent, and I think that manifests itself in the way that they employ people, the way they manage their employment, the way they get rid of employees, how they judge who's a performer and who's not. And I think it's very hard in academia, especially if you adopt that ethos that we're really going to respect the rights of everybody who works here in every single way imaginable, that it makes it really hard to run your school like what it is, like a business, because we get that totally lost, and that you end up starting these programs and hiring people on the back of goodwill and committee recommendations and trying to do things that are performative that just drain the institution of people who do jobs where they aren't directly dealing with students, they aren't directly helping students. Because students, I'm sure at UChicago, and students here, I sit in class after class, is over 100 people, little one-on-one mentorship that is happening. But that said, there are probably 5 bureaucrats at Brown for one undergraduate. Or that's too many, but you get the point. That there are a lot of people here who aren't dealing directly one-on-one with students, who are just giving panels and presentations within Brown as like a circular loop. And I think that there's little benefit that's coming out of that, when these schools should really focus on the core operation, giving people a great learning experience, as much exposure as they can, as small of class sizes as they can, try and grow mentorship and attachment, because having a committee that's going to stand up for, I don't know, I can't think of a politically correct example to use. But having committee after committee that's going to stand up for certain identity groups isn't what's actually drawing attachment to the school. Because once you draw the attachment to the school, parents are more incentivized to donate, the kid feels a much bigger connection, and I think that that's something that you get through athletics too, of why some of these football schools are bringing in a lot of money, is because people are drawn to the program. It keeps them connected to the school. So focusing on that and what's core, I think, would serve all these schools well.
Love it, Adam. Wow, great. I love that take, dude. That was great. And it's sad because a lot of these programs and these people are really doing some great things for kids. And, these are great programs, of course, but you just have to wonder how much of that is directly linked to the amount of revenue that the school is able to generate. And it almost feels weird to think of a university as a business, but at the end of the day, it is in a way. So you do have to think about that, and unfortunately, it looks like that is the route that that might be taken.
Mm-hmm.
So, yeah.
But the ones who do the right things they'll be the ultimate beneficiaries, you would think.
So that was a fun discussion. Maybe we could jump into our last thing. kind of on the topic of sort of this left-wing adoption that these universities are going from. Maybe we need a little more of a left-wing perspective in terms of our unions and our jobs moving forward. Maybe if you want to open this up for us.
Yeah. So I think at a high level, we read this book called Private Government by Elizabeth Anderson for one of our classes. And it frames, when we think about capitalism as it used to be Adam Smith and the baker and the butcher, that you could work by yourself and you could contribute to society, you could contribute to these people shopping, and they would be the beneficiary, and you would be the beneficiary, not by your self-interest, or by your self-interest, not by that you wanted to be a good citizen, whatever, but that it was all a byproduct that worked together. And then as industrialization happened and industrial capitalism happened, that workers increasingly were stuck in the factories and stuck into places where there was one employer in town, say, for the sake of us being in the Rockefeller Library, say it was Standard Oil, and that they were the only people that you could work for. It gave you, little power to resist as someone who was working there, and that they got to rule your lives, rule maybe your political interests, rule how you conducted yourself at work to an extent that we might not find acceptable, and that a lot of these folks tried to unionize together, and that this might be the way that we find a solution to that. That even today we have a lot of big firms that we've talked about, and that this might be the best way for workers to resist against that. And there are a lot of people who are for this, or a lot of people who are against it, and now we'll find out what James thinks.
No, it's very interesting, and kind of the main point is that this all kind of got blown up during the Industrial Revolution. It all worked prior to that, but then the amount of scale and the amount of capital needed, workers kind of became like these, machines just trying to churn away and work in these factories, and unions came in and really provided a lot of relief, even the invention of the weekend, So unions have done a lot of great things, and I believe in the last, 50 or so years, we've gone from 30% of workers being a part of a union to just 10%. So maybe we're due for some sort of a union revival, and maybe that'll boost morale in the workplace and get people the wages they deserve. But I don't know. It's interesting to think, to consider, and I can't help but think about AI again. I think if a lot of these big business owners see people coming together and demanding the bigger wages, they just say, all right, you know what, we were planning layoffs next year, we'll just do them right now, and machine's coming for you. So that's all that I think about whenever this comes up.
And I think that is true. That there's I think Amazon, I had a story on here earlier about that they announced another round of layoffs, and I think a big part of the reason why is that they're starting to face more union pressure, so there's just more and more incentive for them to try and automate, and the economics look that much better if they're able to automate a lot of these jobs. And I'm kind of at a strange place with it, because I think one is that what unions seek to do, in my view, is monopolize the labor supply. That you're trying to build something and you want to use non-union labor that's going to be at a cheaper price, then they're going to say, we are not going to have you do that. We're going to put a big inflatable rat in front of your place, and we're going to protest the hell out of it. And I wonder if that leads to worse employment outcomes for the U.S., because you have people who are in these big companies that have been with the union for 30 years that have now all these seniority protections, severance pay, have become extremely hard to fire, extremely hard for some of these outsiders who are outside the union to either get into the union or get employed by that employer. So I think that there is a deadweight loss there. But there is something to be said that employees who are under a monopsony where there's one employer in town are not going to be, if they're scattered, going to be in a good position if they are one singular person unorganized against a Walmart.
Walmart in every single small town, region in the entire country is just taking over, and you can't find or compete better wages in a neighboring area or the place down the street because Walmart just takes over. It's really a tough place that we come to, and we talked a lot about monopolies last week and antitrust, and maybe we're at a level where Walmart is able to provide lower prices and they keep growing in scale, but this is something I don't think we totally considered. How are workers going to fit into this? How are they going to compete for the wages that they need to feed their families and be in places that respect them and don't make them do overtime every single day? So this is a really tough issue, and I think that we're definitely at a point where people are realizing that they need more rights in the workplace and they want to be more well respected and maintain higher wages. We always come to the argument, wage growth has not nearly kept up with about any other economic indicator, inflation, S&P 500 growth. So I don't know. I really do think we're at an inflection point at this point.
And I would say two more things in regard to unions of why it's a frustrating issue for me is that one, I think the incentive structure is bad in a place where on the monopolist side, if you are the Walmart and you're the only employer in town, that it gives you no incentive to treat your employees well if they have nowhere to move to. But I think the other thing is that you are in an entrenched union and you're a steel worker who's 20 years in the union and you know that it's super hard to fire you. It's very hard for you to have the right incentive to work and want to be promoted, etc. So I think for me, the real solution is to make sure that workers have other places to go. I don't think the best solution is combating monopoly with another monopoly on the labor side. I think the solution here, is to break up some of these big companies to make sure that workers have the max amount of options possible, because we're in a world where millions of consumer brands are owned by the same private equity company, and you try and go around and we can't hire you because you worked for a company that's under the same parent, or whatever the situation might be, is that there's so much consolidation that what you should get as a worker is you should be getting your marginal product of your labor, and that when you're getting under that, you should be able to go across the street and someone will be willing to pay you more, someone will be willing to treat you better because you're a value performer, that you're getting paid off of your actual productivity. And I think that unions distort that, as does a monopoly system where you have companies who are the only game in town.
Yeah, that's a great argument. And I think that also comes into play. I'm going to bring up AI one more time. But when you think about if there's an increase in competition and, Walmart isn't just this giant being where you're looking for one person working there in the entire store to help you find something. Maybe you go across the street to the smaller, mom and pop place that has a little bit more of a personalized experience for you. Mm-hmm. And that is where the human element can really come into play. And then you're more excited to come to work and you are adding more value to the company. I think that it could be a really exceptional thing, especially in the environment that we're in right now.
Absolutely. And I think, interestingly, and this is totally tangential, but was listening to The Acquired on Trader Joe's, but that business model seems to have worked somewhat for them, that there are no discounts, but all the employees, they do all the different things. They all have a certain way that they're supposed to treat you. A business like Chipotle, similar thing, that I think why people gravitate to that brand. So I think that there is a market for having the consumer feel that even if you're paying more at Trader Joe's than you are at Walmart, I think that there is a market that consumers are willing to pay for that service.
Yeah, I'm with you. And that is how I think we can avoid robots taking over. But I think it's also going to add value. Maybe I'll even walk back on my stance that maybe some of these fast casual places could benefit from having the employees there. So we'll see.
We will see. And I'm sure this won't be the last time we talk about it before the robots come. But I think that's probably a good place to wrap this one up. We hope you enjoyed a lot of different topics today. This was one of my favorites.
Yeah, this is a really fun one. Thanks for sticking with us, guys, and looking forward to keeping up.
Thank you.